Hey everyone, welcome back. We're rolling into part 2 of our deep dive into Buffett and Munger Unscripted by Alex W. Morris, a book that's basically a backstage pass to 3 decades of Warren Buffett and Charlie Munger's unfiltered wisdom from Berkshire Hathaway's annual meetings. Last time, we kicked things off with part 1, value investing. How they pick stocks, prioritize quality, and wait for the fat pitch. If you missed it, go back and check it out. It's the foundation for what's coming today. We're now cracking open part 2, valuation and intrinsic value, pulling from meetings between 1994 and 2008 in the OCR pages I've got here. This is where Buffett and Munger get into the nitty-gritty of how they figure out what a business is worth. And spoiler, it's not what they're teaching in business school. Let's dive in. So, quick recap. Morris has compiled 500 Q&A gems from 1994 to 2024 into 13 parts: value investing, valuation, capital allocation, you name it. Part 2's all about how Buffett and Munger size up a company's intrinsic value, the real worth of its future cash flows, not some Wall Street ticker hype. They're not here for fancy models or Greek letters. They're about understanding the business, projecting cash, and buying at a discount. Today, I'll hit key themes: diversification versus concentration, opportunity cost, business quality, leverage risks, and their beef with EBITDA, tying it to valuation. It's a lot, but it's gold, and since this book's a monster, we'll keep this multi-part vibe going. Next up will be part 3, stay tuned. Let's start with a curveball they throw at conventional wisdom: diversification. In 1994, Buffett's chatting styles, Peter Lynch likes to diversify a lot more than I do. He owns more stocks than the names of companies I can remember. But that's Peter. There's more than one way to get to heaven. He's not knocking Lynch. Guy's a legend. But Buffett's wired differently. He and Munger are all about concentration when they're sure. Same meeting. He says, "We are willing to put a lot of money into a single security, up to 40% in a single stock," in his partnership days. Munger nods. Sure, they'd dump 75% of their net worth into one idea if it's a lead pipe cinch. Their words from 2008. Why? If you know a business, its economics, management, price, why scatter your bets? Buffett in 968. Diversification is protection against ignorance. If you know how to analyze businesses, it's crazy to own 30, 40, or 50 stocks. Munger's brutal. Much of what is taught in modern corporate finance courses is twaddle. This ties straight to valuation. They're not guessing across 50 companies, they're zeroing in on a few where they can nail the intrinsic value. Take 1996. Buffett's like, "I own one stock, Berkshire. Do I need 28 stocks for diversification?" It'd be nonsense. He'd pick 3 Berkshire businesses over 50 average ones any day. Munger doubles down in 2012. The Munger family is in 2 or 3 things only. "I rejoiced the day I got rid of a stock," quoting machine. They're betting big on what they understand, valuing a handful of wonderful businesses over a diversified mush. In 2025, with index funds everywhere, this feels radical, but it's how they've built Berkshire into a 500 billion plus empire. How do they pick those winners? Opportunity cost is their yardstick. In 2003, Buffett's measuring. "We don't want to buy equities where our real expectancy is below 10%. We feel we will get opportunities at least at that level." They're not chasing every deal. They're comparing it to the best thing they already own, like Coca-Cola. In 95, he says, "Why would I rather have this than more Coca-Cola?" Munger's savage. for an ordinary individual. If the new thing isn't better than what you already know, that screens out 99% of what you see. It's a mental filter. Every dollar spent has to beat the next best option. In 2001, Munger ties it to prep. Opportunity comes to the prepared mind. It's very hard to teach business based on opportunity cost. They're valuing not just the business, but the trade-off, guessing future chances against today's cash pile. A 16 billion earning 1.25% in 2003, waiting for a 10% loss. Slam dunk. Business quality's the bedrock of their valuation. In 98, Buffett's clear. The best business gives you more and more money every year without putting up anything. Where you really want to be is in businesses that are good and better 10 years from now. Time's your friend with a 20% return on equity company. Your enemy with a 5% one. Munger in 96. A great company remains great for 30 years. Decisions are easy. Think See's candies, low capital, high returns, no headaches. Contrast that with airlines or textiles. Cash sinks where you're forced to reinvest just to survive. In 2003, Buffett's picky. We've become very partial to businesses where predictability is high. Valuation's easier when you're sure the cash will flow for decades, not when you're praying for a takeover. They ditch the cigar butt approach. Cheap, lousy businesses with one puff left. Buffett in 1980. We gave up. It doesn't work with big money. Time is the enemy of the poor business. Munger. It's not fun to buy a business where you hope it liquidates before it goes broke. Early Berkshire was a cigar butt. Cheap, but a textile dud. They'd rather pay fair for a gem than bottom feed. In 2001, Munger notes the world's changed. Nowadays, somebody else owns the working capital. The culture has shifted. Valuations about future cash, not just today's discount. Leverage. They hate it. In 2004, Buffett warns, the only way smart people get clobbered is through leverage. Oh, it prevents you from playing out your hand. Options, futures, margin, it's dynamite. In 97, borrowed money frequently leads to trouble. Why risk losing what you need for what you don't? Munger in 2005 tells a horror story. A guy with a 5 million portfolio selling naked puts on internet stocks, losing it all. It was not smart for this country to legalize gambling everywhere. Valuations about owning businesses outright, not betting with borrowed cash that can vanish when markets tank. Then there's EBITDA, their punching bag. In 98, Buffett's livid. Why regard Kate as utter nonsense? Oh, to look at a figure before the cash requirements of staying in the same place is absolute folly. Munger in 2017. Substitute bullshit earnings every time you see it. Depreciation's real. You spend first, earn later. Wall Street loves buy to juice valuations, but Buffett in 2003, not thinking of depreciation as an expense is crazy. It's cost a lot of investors a lot of money. In 2002, he notes fraud clusters around eBay today fans, not Walmart or GE. Valuing a business means counting eye-roll costs, not cherry-picking to look smart. How do they actually value stuff? It's simple but not easy. In 95, Buffett's first question, can I understand it? Or does it have good economics? Munger. What judge by the past record? A lousy past and bright future. We'll miss it. They're not biotech wizards. They stick to their circle, like Coca-Cola or Jiaso. In 99, Buffett's investigative. Talk to competitors. If you had a silver bullet, who'd you shoot? It's scuttlebutt. Phil Fisher's trick, layered on Ben Graham's margin of safety. In 979. If you understand the future perfectly, you need little margin. The more volatile, the larger it needs to be. They aim for predictable cash flows, buying at a 25% of value when stars align, but they'll settle for good at a reasonable price, over waiting decades. Mistakes haunt them, not commissions but omissions. In 2001, Munger laments, "The most extreme in Berkshire's history are mistakes of omission. They show up in opportunity costs." He passed on 500 shares of Belridge Oil, cost him $200 million. Buffett. What's an error is when it's something we understand, and we don't do anything. Sucking. Starting small when they should have gone big. Stings worse than any loss. Valuation's not just numbers, it's having the guts to act when you're sure. Size limits them now. In 2007, Buffett's size. "If I were working with small sums, I'd be doing entirely different things. You can earn very high returns with a 10,000. With Berkshire's a 100 billion plus, they're stuck with giants, a 50 billion market caps or more. In 2008, would be happy with 10% pre-tax returns will be less than the past. Munger's cool with it. We're very happy making money at a rate way less than before. Valuation's tougher when you're needle. Movers are behemoths, not hidden gems. What's the takeaway? Intrinsic value's about cash you can pull out over time, discounted back, bought with a cushion. They skip the noise. Charts, options, EBITDA, focusing on businesses they get with durable edges run by obsessed managers. Diversifications for the clueless, concentrations for the confident. Opportunity cost keeps them disciplined and leverages a trap. In 2025, with crypto hype and AI buzz, their old school clarity cuts through. Value what lasts, not what flashes. We've got filters like the 5-minute test, scuttlebutt, and more to unpack. But let's save that for later. Next time, we'll hit part 3, capital allocation. How they deploy Berkshire's cash, from buybacks to acquisitions. It's where their valuation rubber meets the road. For now, chew on this. Could you bet 75% of your net worth on one idea? Buffett and Munger did, and it's why we're still talking about them. Grab the book if you haven't. 300 pages of this stuff is a brain workout. Let me know what you think. Hit me up. And I'll catch you soon for more from Omaha's finest.